I'm Deborah, the founder of Elevation Wealth Partners, and this is the Elevation Market Update. Today, I'm in conversation with Dan Fearnow of MFS Investments. Dan travels a lot. He's worked with that company for 25 years, but when he's home, he's based in Denver, Colorado with his family. Welcome, Dan.
Welcome, Deborah.
Okay. So we spoke in January, the beginning of the year. So why don't you start us out by just giving a short recap of what's been happening so far this year?
Yeah, I think everyone would agree that it's great to have 2022 in the rearview mirror, right? I mean, just to think about what we went through last year and really all the unprecedented events that came together. The global pandemic that continued onward. We had a bear market. We had a technical recession, 2 negative GDP quarters. We had runaway inflation, and we had a European war, right? And so all these events that, on their own, are very low probability the last 100 years of happening any given year. And the fact that all 5 of those happened in the same year, the probability is actually 0.01%. So you're saying there's a chance, right? And it happened. And the market suffered, both the bond market and the stock market suffered. And if we look into 2023, where we are today, we've had recovery. We still have some of those challenges, still have a war in Europe. We still have inflation that's starting to tail off here. We have a pretty aggressive Fed. We had a debt ceiling debate and limit, and certainly I don't know about resolution. They kind of kicked the can down to I think January 2025, the proverbial can, right? But the fact of the matter is the markets have recovered. If you were disciplined, you didn't let your emotions take over. Both the stock and the bond markets are trending up here so far this year. And so you had to really go through the pain of 2022 to enjoy the pleasure of the upside for 2023. And that's where we find ourselves right now.
Yeah, so let's talk about recession. We've been talking about that possibility for a long time. So what do you have to say about that?
Yeah, I mean, certainly that's been the biggest concern. Certainly, if you look at the newspapers, I think it's gone from kind of the Fed action of last year to recessionary concerns. There's only one body that determines whether a recession happened or not. It's the National Bureau of Economic Research, and the debate will continue to go on this year. I think you have certainly some challenges, whether it's housing prices starting to fall here. You have manufacturing starting to fall as well in the last few quarters, but you have a really strong job market. If you want a job, you can find a job out there. And the consumer still seems pretty darn resilient. We look at the retail numbers that came in this week, pretty strong. So I guess if recession is out there, maybe it's going to be a little more on the mild side, but we continue to monitor that. And I think certainly at the end of the day, the fact that the Fed certainly looks poised to maybe stop this rate increase environment, which should help the consumer and the economy for sure.
Yeah, and you mentioned the interest rate increases by the Federal Reserve. This has been unprecedented, hasn't it? The movements they've made, and it's one of the biggest concerns, I think, still, right?
No doubt. I mean, the Fed has been extremely aggressive. The trajectory of these 11 hikes going back to March of 2022. I guess one of my colleagues said we're overfed at this point, but a little humor there. We're sitting at about 5.5% on the Fed funds, and that's been certainly a challenge. And there's a debate whether they're done or whether there's one more or several more. I don't know if that really matters. I think at the end of the day, we're closer to that end, which should be a good thing for the consumer, for again, the economy overall.
Yeah. And I've just been really surprised to see out there in the media already, people talking about when is the Fed, that they're going to reduce rates and start backing off from that in 2023.
Yeah, certainly going into 2023 and still seeing that there's some pundits out there that think that we're going to get maybe some rate cuts this year. No one knows. I just think the fact that the Fed chairman, Fed Powell, is a historian. And if you look at what happened in the 1970s when we had a really big inflationary challenge, we raised rates, the Fed raised rates to try to kill inflation. They thought they killed inflation. They started cutting rates, and then inflation reared its ugly head, and they had to aggressively go back to raising rates. So I just think Powell doesn't want 2.0 of the 1970s. So I think it's going to be more of a hold, a pause to see what's happened. There's some lagging indicators that they'll look at. They'll use the almighty data dependent type of input to make sure that inflation is certainly contained and in that 2% zone where they want it.
And it definitely takes time, doesn't it, to see all the ripples go out with these actions they've taken?
No doubt. Certainly tons of lagging economic indicators or just lagging factors out there that will take time. And I think the Fed is in no rush to certainly come and start cutting after the trajectory they've given us over the last 12 months or so.
Mm-hmm. Yeah. So I know that the job of your company, MFS Investments, is to figure all of that out and then go looking for the opportunities. So where are they seeing that right now?
Yeah, certainly. And I don't give investment advice. That's what you do, Deborah, for a living, and you do a great job of it. So, but as an asset manager, when we look at broad opportunities in the marketplace right now, and again, the damage that was done in the bond market last year presents some interesting opportunities in a place like the municipal tax-free market that was hit with a ton of redemptions, outflows last year. I think there are about $122 billion that left the muni market, which was historic after 121 or so billion went into the market in 2021. So an about face for sure. But we're starting to see investors come back into that tax-free space because at the end of the day, the only option for tax-free income investing for the most part is muni investing. So they will come back. They're starting to come back. So the demand is starting to pick up here. Still a little challenging. We've had some positive inflow weeks. We've had some negative inflow weeks, but maybe the fire hydrant of redemptions is become a garden hose, and certainly has turned the corner from what we can see for the most part, which presents opportunities. The fact that demand is starting to pick up, supply is pretty constrained. So what we would call technicals, supply demand, are pretty favorable right now. If we have rising demand and supply that's pretty constrained, and then you throw in the fundamental picture, the health of the states that really benefited from COVID, the rainy day funds the government gave to these states to buffer their balance sheets is still in place. So fundamentally speaking, they look pretty sound, and so we definitely see certainly some opportunities in investment grade, high quality municipal bonds and portfolios. We had a negative year of munis last year. We've never had a negative year back to back in investment grade munis. So I'm hoping I'm not jinxing anything right now, but that's just the statistic.
Yeah, please don't.
I will not. I promise. Do my best. So that would be an opportunity on the bond side. Certainly on the equity side, it still pays to be diversified. It seems like large cap, mega cap tech companies certainly have run the roost. The Magnificent Seven have been the big winners this year. But just to keep in mind that there are other asset classes, other styles on the value side that I still think makes a lot of sense to basically have a nice barbell of growth with value. where if we do have recession, then those are the type of sectors that typically hold up maybe a little bit better historically in that type of environment. And certainly, if we look internationally outside the U.S., we're finding opportunities. And the fact that the international markets typically are a little more value oriented, versus the S&P that's very concentrated in those tech names. Outside the U.S. and the EFA, the industry, the benchmark, you have, again, these sectors, financials, healthcare, that typically hold up better in inflationary environments historically. So the opportunity to look outside the U.S. at these opportunities, international has had a huge headwind the last, call it decade, with a very strong dollar. And if you look at what we've had so far this year, we've had a weakening dollar, softening dollar, which is a tailwind for ex-U.S. investing. So we certainly like international. We see opportunities there. And if we're looking at styles, certainly still leaning in on larger cap companies that have strong balance sheets, that have free cash flow, that should hold up if there are some recessionary winds out there.
So I know one thing I'm seeing in the news and people starting to talk about and getting excited about is artificial intelligence, or AI. So how is that playing in? Like, is this news to your company, or is this something that's already been on the radar for a while?
Yeah, I mean, I think certainly this year, the technology, the evolution of AI is here. If I think about my career, it was everybody wanted to be .com in the late 90s. Everybody wanted to be kind of cloud associated in the 2010s. And now everybody wants to jump on the AI bandwagon, if you will, and tons of funding in that space. Small companies are being created every day. We went from funding fintech and biotech, and now it seems like the hot dot up there is AI. And as an active manager, Deborah, I mean, just trying to decipher through the noise, do our research to try to figure out what companies, what industries will benefit, which companies, industries will be neutral to this new intelligence, this new artificial intelligence. And then, obviously at the end of the day, try to figure out who it's going to hurt and to be active in our choices there. So far for MFS, we're more of a picks and shovel type approach. The bigger, larger, more established tech companies that will give the hardware and the power to this artificial intelligence evolution seem to be a pretty good opportunity for us right now.
Well, it sounds like some interesting developments coming, and that's why it's been so interesting in your career, right? You didn't just get to do the same thing all these years.
Yeah, no doubt. Exactly.
Yeah.
Change is constant, as the saying goes, right?
Indeed. Yeah, so it is time for us to wrap up today. So Dan, if you'd like to give me your final thoughts here.
Yeah, no, I appreciate the opportunity, Deborah, as always. The fact of the matter is, at the end of the day, diversification and certainly being active on the investment side it never goes out of style. I don't care what type of market environment. And to have to go through some of the pain of last year in 2022 to enjoy the upside in 2023, that is what is out there for people that stay disciplined and have a game plan and use a financial advisor. So keep the faith is my message for today.
All right. Well, thanks, Dan. Great information this morning. And that's it for today for our show. We hope that you found it helpful. If you have any questions, feel free to reach out to us. We will be posting this very soon to our website, to our social media, and sending out on email to our clients. Thank you very much.